Welcome to the deep dive. Today we're opening up the playbook for the National Bank of Canada, or NBC.
Right.
Now, when you look at these big banks, they're usually doing one of two things: focusing on growth, or digging in on integration and risk.
Mm.
What's so fascinating here is that NBC basically spent the last year doing both at the same time, while navigating a pretty choppy economy and pulling off the biggest acquisition in their history. And, well, they just announced the next one.
That's absolutely right. And for our sources today, we've got the Q4 and full year 2025 investor presentation and the press release that goes with it. Both just came out.
So what's our mission here?
Well, our mission is to take you through how they did it, how they hit some really aggressive financial targets, how they accelerated the integration of Canadian Western Bank, the CWB deal, and what this brand new Laurentian Bank deal tells us about where they're headed.
Okay, so let's start at the top. Fiscal year 2025. They laid out some medium-term objectives, specifically for adjusted diluted earnings per share, or EPS. They were aiming for growth in the 5 to 10% range.
Yeah, and they didn't just meet it, they landed right in the middle of the bullseye. For the full year, NBC reported an adjusted diluted EPS of $11.28.
Which is, what, a 9% growth?
Exactly, 9% growth year over year. And to hit 9% while you're also digesting a massive acquisition like CWB, I mean, that's a huge operational win.
And what about efficiency, return on equity?
Their adjusted return on equity, or ROE, came in at 15.3%. So again, firmly inside their target range of 15 to 20%. When a bank hits both growth and efficiency targets in a year like this one, it just signals really tight discipline.
That strong full-year number must have had a big finish. Let's look at Q4 specifically. Adjusted net income up 25% year over year. But you told me the real story is in the pre-tax, pre-provision earnings.
Yes, PTPP. That's where you see the real strength. Adjusted PTPP saw this massive 33% jump year over year in the fourth quarter.
So why is PTPP the number to watch?
Well, you can think of it as the bank's core engine, stripped of all the external noise. It's basically revenue minus expenses. But before you factor in taxes or, and this is the critical part, how much money the bank is setting aside for loans that might go bad.
The provisions?
Exactly. A 33% PTPP growth rate tells you the core business making money and controlling costs is just incredibly healthy.
Okay, so if the engine is running 33% hotter, what's fueling it? Let's break down where that revenue growth is coming from in Q4.
The clear standout was capital markets. That whole division just finished what the bank called a record year, and the momentum was huge. Segment revenue was up 38% year over year.
38%. Wow, that's a staggering number for an institutional business. What was driving that?
It was really firing on all cylinders. On one hand, their global markets division, that revenue was up 42%. So a lot of activity in securities finance, complex equity products, that kind of thing. And then at the same time, the corporate and investment banking side was also very strong. Advisory, financing. Their revenue was up 33%. It just shows their whole institutional footprint is getting bigger.
All right, what about wealth management? That's usually a good sign of market health and whether they're attracting new money.
Yeah, wealth management had a great quarter. It delivered double-digit net income growth. I think it was 18% up year over year, which also cemented a record year for them.
And revenue?
Revenue growth was right there with it, up 19%. You can really see the strategy working when you look at assets under management, AUM. That metric surged 25% year over year.
Now, how much of that is the CWB deal?
That's the right question. If you actually pull out the CWB impact, AUM still grew by an impressive 19%. So that's driven by the market and, real net sales, strong organic growth.
It feels like every part of the bank is working well, even before you really factor in the big acquisition. So let's talk about the core domestic business, personal and commercial banking, or P&C.
Right. So headline revenue for P&C was up 25% year over year, which, obviously has a lot of CWB in it.
Of course.
But what I look for is the organic strength underneath. And if you strip out CWB, you still see really solid performance. Personal mortgages up 8% year over year, and commercial loans, which are so important, were up a very healthy 12%. The core book is growing.
And just to round out the segments, what about their U.S. and international arm, the U.S. F&I?
U.S. F&I saw revenue up 12%. The really interesting story there is ABA Bank, their international piece. Net income was up 8%, which is good, but the client base, it grew by 37% in 1 year.
37%.
Yeah. That's just explosive client acquisition. It really speaks to how well their international strategy is working.
Okay, let's unpack the big one, the cornerstone of the whole year, The CWB acquisition, it closed back in February 2025. And big bank deals, they're famous for delays and missed targets. NBC is claiming the opposite.
They are, and they're putting numbers behind it. They've actually accelerated their synergy timeline by more than a year.
A whole year.
A whole year. The full target was to get $270 million in cost and funding synergies. They now expect to hit that by the end of fiscal year 2026.
Right.
That's a huge validation of their integration team. They've already realized $116 million just this year.
Getting costs out ahead of schedule is a big deal for investors, but what about the other side of the coin? Growing revenue from the deal.
Right, the revenue synergies. The plan there is to get about $250 million by the end of fiscal year 2028. And that comes from basically cross-selling, taking their wealth management and capital markets products and offering them to the CWB commercial clients they just brought on board.
Turning them into multi-service clients.
Exactly.
This next part seems like it shifts from just good execution to, well, really smart capital management. An acquisition like this usually dings your capital ratio for a while, but NBC seems to be setting it up to actually boost their capital down the line.
This is the aha moment in the presentation. It all comes down to migrating CWB's loan portfolios to something called the Advanced Internal Ratings-Based Framework, or AIRB.
Okay, bring that down for us. What is AIRB?
So most banks use what's called the standardized approach. Regulators give them fixed formulas to figure out how much capital they have to hold against their loans. It's pretty rigid.
Right.
AIRB is different. It's for banks that are, highly disciplined. It lets them use their own deep historical data and internal models to assess credit risk more accurately.
And the benefit of doing that is?
Well, if NBC can prove to the regulator that the CWB loan book is less risky than the standard formula assumes, the regulator lets them hold less capital against it.
So it frees up capital.
A lot of it. They're expecting to free up between 50 and 75 basis points of their CET1 ratio over 3 years. And the biggest chunk of that, 35 to 55 basis points, is expected in Q4 2026.
So the acquisition is a temporary capital expense that turns into a long-term capital advantage.
Precisely. It's a very clever move.
So they absorb the steal, their loans and deposits both jump 25%, and they still end the year with a really strong CET1 capital ratio of 13.75%. That stability plus the future AIRB release, that gives them a ton of flexibility.
It absolutely does. And we saw them use that flexibility almost immediately, didn't we?
With the Laurentian Bank deal, exactly.
Yeah.
So let's get into that. Just announced, NBC is buying a bunch of portfolios from Laurentian. What are they picking up?
This is a much more targeted strategic move.
Yeah.
It's really about reinforcing their position, especially in Quebec. They're getting retail and SME portfolios that include $3.3 billion in retail loans, $7.6 billion in retail deposits, and another $1.4 billion in small business loans and deposits.
And how many clients come with that?
About 260,000 new clients in one go.
That's a big boost to their client base. And there was a commercial portfolio, too.
Yes, a syndicated loan portfolio, about $0.9 billion of commercial and corporate loans. That part of the deal is actually set to close pretty quickly, early in 2026. The bigger retail and SME piece will close later in the year.
So how does this smaller deal impact the financials?
Well, it's smaller, but it's very efficient. The main transaction is expected to be accretive. So add to their adjusted EPS by about 1.5 to 2% in the very first year, and the capital hit is really modest.
How modest?
We should only reduce their CET1 ratio by about 25 to 30 basis points. And when you're starting at 13.75% and you've got that big 35 to 55 basis point boost coming from the CWB integration, well, it's very manageable. They're just using their strong position to consolidate market share.
So if 2025 was about execution, what's the outlook for 26 and 27? And more importantly, how are they managing credit risk with, everything going on with inflation and interest rates?
For fiscal 26, the guidance is pretty steady. They're keeping their adjusted EPS growth target in that 5 to 10% range. And on the risk side, they're guiding for provisions for credit losses, or PCL, to stay in a prudent range of 25 to 35 basis points.
And looking further out, when do all these deals really start to pay off?
Fiscal year 2027, that's the target year. That's when you'll have the full weight of the CWB synergies and the Laurentian deal benefits hitting the bottom line. And they're specifically targeting an adjusted ROE of 17% or higher. So there's a very clear path here.
Okay, let's get back to the immediate risk. How did their Q4 credit performance actually look compared to that future guidance?
It was remarkably stable. The impaired PCL came in at 28 basis points.
So right in the middle of their guidance for next year.
Right in the middle. It shows that, they're seeing some credit stress, but it's completely within what they were expecting. It's manageable. And their total buffer for losses is very robust. It covers their actual net charge-offs by 5.5 times. That's a very prudent stance to take.
The big worry for everyone, though, is the Canadian housing market. How does NDC's exposure look there?
They were very transparent on this, which is good to see. Their total Canadian residential real estate portfolio is big, about $112 billion. But the part you worry about most, the high-risk, uninsured borrowers, that's less than 1% of the whole portfolio.
Less than 1%?
Yeah. It suggests they've been very, very selective about who they lend to in those riskiest categories.
Okay, that's a key detail. But what about the big, expensive markets? Toronto, Vancouver.
Even there, if you look at their uninsured mortgages and HELOCs in the GTA and GVA, it's less than 15% of their total residential portfolio.
Yeah.
And more importantly, the average loan to value, the LTV, on those loans is 58%.
Which means their clients have a lot equity.
A huge equity cushion, a really strong buffer if prices were to fall.
All right, now for the question on everyone's mind. The fixed-rate mortgage renewal cliff. What does NBC's exposure look like?
The clock is definitely ticking. They note that about 32%, so roughly a third of their fixed-rate mortgages, are coming up for renewal by the end of fiscal year 2026.
A third. And what kind of payment shock are those people looking at?
This was the surprising number. They estimate their clients will see an average monthly payment increase of about 10%.
Only 10%. That seems almost low, given where rates have come from.
It does. But they provide a really crucial point of comparison. They point to their variable rate mortgage clients. That group has already absorbed an average payment shock of about 26%.
Then they've managed it.
They've managed it. That shock has actually come down from its peak. So the thinking is, if the group that faced a 26% hit is resilient, the bank feels pretty confident that the group facing a much smaller 10% average shock will be able to handle it.
This deep dive really shows a bank firing on all cylinders. They delivered 9% adjusted EPS growth in a tough year. They're way ahead on the CWB integration, which will actually free up capital. And they're already using that strength to make the next move with Laurentian.
It's a story of disciplined execution. But if you connect all these dots, especially that surprisingly low 10% payment increase for fixed-rate renewals, it does raise one last question for you to think about.
What's that?
Well, what does this concentration of a, relatively modest but still widespread renewal pressure in 2026 suggest about the pace of consumer belt-tightening that's still to come across the whole economy? If a third of their mortgage book feels a 10% squeeze next year, even if it's manageable, that's still a drag on spending. You should watch to see how quickly that renewal wave starts to nudge up PCL guidance across the entire sector next year.
That is the ripple effect to watch. A great point to end on. Thank you for walking us through all that complexity. And we'd encourage all of you to check out the source material, the NBC investor presentation, to see the details for yourself.